Good afternoon, everyone, especially to those on the Eastern and Central time zones, and good morning to those of you in the Mountain and Pacific time zones. Welcome to today's webinar, Defining Current Trends in Middle Market Staffing Industry. A couple of housekeeping matters before I proceed to introduce the panelists. First, we do want this to be interactive, so please feel free to submit your questions as we proceed. I will look at those questions and try and pass them on as appropriate. Also, at the end of the webinar, we will take some time to answer additional questions. Second, the webinar is being recorded, and you will be receiving the recording after the webinar, probably later today or tomorrow. And finally, we have a good deal of material to cover. So many interesting issues that are arising in M&A today under these conditions. We're going to try our best to cover it in the hour allotted, but we may end up going a little bit over. First of all, for those of you who don't know me, Marty Barasco, I chair the staffing practice group at Becker. Becker, I believe, has the largest staffing practice group in the country in terms of the number of clients represented, over 100, and the number of attorneys dedicated to the staffing practice. I spend 100% of my time working with our staffing clients. I don't stroke a keyboard or pick up a pen for anybody but our clients in the staffing industry. I spend most of my time assisting staffing clients on strategic matters such as M&A and finance. Becker has been involved in over 30 M&A transactions in the staffing industry in the last 2.5 years. And we'd recently closed GI Holdings Group acquisition of CareerArc. You might have read about it in SIA, and have 5 industry deals that we're working on presently. I look forward to sharing what we are seeing in the market with everyone today. I have 3 M&A and finance veterans from the staffing industry joining me as panelists. The first I'll introduce is Patrick Morin of Transact Capital. Patrick leads the staffing practice group at Transact. Transact is one of the leading middle market investment banks in the staffing industry. Under Patrick's stewardship, Transact has closed 22 transactions in the past 2 years. Those deals ranging in enterprise value from 10 million to over 100 million. I know Patrick has a number of clients in the industry that he is working with and taking to market today. Patrick, I look forward to hearing your assessment of the current market. Good afternoon.
Thanks a lot, Marty. I appreciate it. I'm excited to be here.
Also joining us today is Paul Maring, co-president of Access Capital. Access Capital is one of the leading lenders in the staffing industry. Paul oversees the new business development and the underwriting departments at Access Capital. Paul has spent the last several decades working with staffing owners and C-level executives on how to scale their business utilizing flexible and effective finance solutions. Good afternoon, Paul.
Thanks, Marty. Glad to be here.
And finally, we have Nick Florio joining us, CEO of Strategic Staffing Consultants. Nick has 30 years of experience in the staffing industry. He advises staffing firms in a number of strategic areas, including M&A. He has experience sitting on and advising various private and public boards on staffing M&A. I know from speaking with Nick recently that he is currently working with a number of buyers and sellers. Good afternoon, Nick.
Thanks, Marty. Happy to be here.
Well, let's get right to it. I know that this is the question that most people on the call, on the webinar, are looking for us addressing, and that is, what is the state of valuations in the market? Patrick, where are valuations in the market overall? Maybe you can also go sector by sector and let us know what industry sectors have been most impacted by the pandemic.
Sure. Overall, there's been an actual slowdown in deals, but there's not been. They're mostly on the pause side. They're not necessarily like obliterated. They slowed down a little bit. But anybody coming in to buy staffing companies, what we've seen typically in light industrial, that's eased off. They've taken the foot off the accelerator from some of those abnormally high valuations that we were getting in the latter part of last year. And also in permanent placement and search, those were also banged up pretty badly in terms of total valuations. But where we're not seeing really any slowdown is both in healthcare and in tech, especially in tech. Tech just keeps marching on, and that's pretty broadly. Skilled staffing is holding its own, if not coming off a little bit lightly. But we're seeing, surprisingly, I think we're seeing a lot of strength coming through in the multiples, meaning they didn't fall off precipitously in almost any of the sectors except for probably hospitality. And hospitality ended up getting banged up the absolute roughest of all of them. And I think that's one of those Captain Obvious moments, Marty, where you realize that people aren't traveling, they're not staying in hotels, they're not staying in anything like that. So you would expect that to fall off the most.
Yeah, I think that's conforming with what we're seeing. Nick, how about you? Is that what you're seeing as well?
Yeah, my insights are mirroring what Patrick's saying. The multiples, there's a little bit of vacillation in the multiples. In fact, in healthcare, they may actually be higher than lower. I think the reasons tech is doing so well is there are a lot of folks right now dealing with to get companies ramped up quickly with remote workforce and technology to use from various points of access. A lot of small to mid-sized companies weren't prepared for that, so tech is seeing a surge specifically in those areas, and healthcare, as we know it, is seeing a surge with nurses, RNs, nurse practitioners getting into hospitals and facilities trying to treat COVID. So the question is whether or not these increases in revenue are going to be a spike or whether or not they're sustainable. So there's a bit more scrutiny being placed on forward-looking projections right now within those two industries, given the amount of attention that's being focused in their business related to COVID itself.
I know Paul and I were talking 2 weeks ago about healthcare and another issue that healthcare is dealing with, and Paul and I were talking about it, is the transition from supplying essential healthcare workers, and then in some regions, obviously, that the supply and demand for that has waned, and then you got to get the non-essential healthcare workers into the institutional settings, and there's been a little bit of a kind of dip in that transition. Paul, talking about that, and maybe also talk about the state of the finance market today.
Yeah, no, I think you're right on with that, with the healthcare comment, and I think we're seeing a lot of similar starts and stops throughout different sectors. I mean, it almost feels more like this is a roller coaster recovery than anything else. But yeah, no, financing's available. The money that liquidity was in the market pre-COVID didn't go anywhere. If anything, it's increased. It clearly paused for a couple months, March and April. I mean, there were some deals getting done, but I think virtually the market shut down while we all evaluated who was impacted and who wasn't impacted. I mean, the most significant thing that any buyer can provide a lender on an acquisition financing request is predictability of revenue and EBITDA. And that's tough to do in this environment. Some sectors, as you pointed out, healthcare, IT, can provide that easier than others, but it's still a challenge. But things are opening up each month. May, we saw more transactions than April. We're working on more transactions now. We closed a deal a few weeks ago, one that was supposed to close the end of March, but for all the reasons we know, the pause was hit. And as we evaluate whether certain buyers and sellers are impacted or not impacted by COVID, it allows us to proceed in doing transactions.
I'd like to jump in on the back of what Paula just said, because when he was talking about the money kind of accruing on the sidelines, waiting for some things to happen, I think that's exactly right, because even our phones are ringing off the hooks from buyers who are seeking out buying opportunities. not just necessarily bottom fishers, because you're always going to get those in any market. But when they start looking around and saying, all right, we've got some shekels, we've got some dollars to spend, how are we going to best do this? Are we going to do it organically, or, is there somewhere else we could do it? They still had a plan, and that's both on the private equity and on the strategic side that we're seeing that the hunters have really entered the market. They're being a lot more careful in terms of what they buy and how they're looking at companies, but the money didn't go anywhere. It just rested for a little bit.
Yeah,
Nick.
Right on. I will add on though, deals are getting done a little bit more conservatively, less leverage. Buyers got to be prepared to bring more capital to the table or structure something different than sellers. That's one clear change today, that the amount of leverage you can get through a financing arrangement isn't what it was pre-COVID.
Paul talked a little bit about the traditional finance market. Nick, we're in a really unique kind of environment today, and there's a number of sources of what I would call non-traditional finance, and there's also the impact of buyers receiving PPP loans. Can you talk about how those things are impacting the finance market?
There's the traditional sources of capital, as Paul points out, still available. You're starting to see a lot more mezzanine debt enter the equation, even in smaller deals or mid-sized deals. But the real compelling issue today is mid-sized staffing firms who received PPP funds, I'd say in the range of $3 to $5, perhaps even $7 million, now have a fair amount of liquidity because they stopped using their ABL loans and instead use PPP funds to fund their payroll in anticipation of future forgiveness. And so now they've got fat bank accounts, and you have a lot of new buyers, first-time buyers, sitting on a lot of money, looking to put that into market to try to find some distressed companies to buy right now. And so that's a new dynamic in the market, and that's a new source of capital because they're counting on forgiveness, but weighing in that even if it's only partially forgiven, you've got 5-year money at 1% to put to work. And so people are looking to take advantage of that. And so there are a lot of new small target buyers in the market currently using their own money.
Yeah. No, go ahead, Paul.
No, go ahead, Patrick.
Yeah, we're seeing exactly that, which is you've got these cash balances and you've got owners saying, well, I've always wanted to expand out. Let me see if I can go pick off someone else. So it really is a lot of those first-time buyers. People had never really had an M&A strategy before, starting to look around to see if they could gain a foothold because they're feeling flush with the anticipation that they're not going to have to pay back that PPP. And then to speak to the mezz debt, there's a lot of deals are being structured with mezzanine financing out there. Obviously, you get the higher interest rates. Obviously, it's going to be subordinated to other things. And as Paul said, you've got to bring a stronger balance sheet to some of these deals, or at least when you're looking at a transaction. So I think that's also one of the reasons why you're seeing more mezz coming into deals as a whole to come in subordinated to the senior.
Paul, quick question to you, maybe two parts. One, I don't know if you commented on the cost of financing today. And also, can you comment on where you see the finance market in 6 months?
Yeah. So I think two things that are going to be most prevalent in the changes. And one, as you touched on, Marty, the cost of financing is going to go up. It hasn't yet filtered into the market immediately, but over the next 6 months, we are anticipating the credit markets tightening up on cost. I mean, with interest rates back to where they were for many years, yield compression is high on everybody's list. You're seeing it with the banks. So they're going to, the markets are going to raise cost of financing. So it behooves everyone to build that into their model because it's going to happen, even though it hasn't just yet. And then the second point is, and I think Patrick and Nick touched on it, is we're going to see what we saw post Great Recession, where the big banks are not going to be very active in lending. The traditional banks will not be as active, and the non-traditional sources of capital will continue to grow in the same fashion that they grew post-recession, because a lot of private money is what really financed a lot of the growth, the economic growth from the Great Recession till now.
Nick, given what Paul just said, that finance is going to get a little bit more expensive, traditional banks may not be as active in the market, what impact is that going to have on buyers, and maybe in particular PE buyers in 6 months and a year?
Well, for the PE market, it's all about return on investment and return on equity. So if their cost of capital is higher, that's going to somehow have to be reflected in valuations as an offset. And while I don't expect valuations to vacillate much, the anticipation is perhaps outside of IT and healthcare, you might see, a half a turn, 50 bips on multiples difference, so that if you were seeing perhaps a 5 multiple in, a nice white collar professional business area, that multiple may not be, 4.5 instead of a 5 turn on adjusted EBITDA. It's going to have to get made up somewhere. I think there also might be less cash up front coming into a deal as it gets more expensive. So Patrick, I'm interested in hearing your input on this as well, but traditionally you'd have a 70-30 type deal, 70% of cash up front, 30% either in the format of earnout to the seller or a seller note, some combination thereof. I don't think you're going to see 70% cash up front in deals anymore once higher costs of funds start to entrench itself.
We're actually already seeing that now. And we have a couple of deals where the valuations actually remain the same. So, the multiples stay the same, but the way that the deal was structured, it starts to get jiggered where you're getting less cash up front. And what's interesting is the seller note is the thing that's starting to shrink. So even if there is such seller note, it as a relative percentage to the other two, we're seeing some of those. We're seeing a lot more earnouts come forth, and it's that shifting of the risk back over to the seller to say, okay, we're not really sure what the post-COVID impact is going to be on your customer base, and we need to be able to share some of this risk. So we're definitely seeing the amount of cash being brought to the table on new transactions. On ones that were already under LOI, they're obviously fulfilling the obligation. They're trying to move it. But I would agree with you, Nick, that the amount of cash coming to transaction is lowering, but you're starting to see a lot more on earnout. And if they are taking a seller note, and I think, by the way, on that one too, because those seller notes are typically behind the mezz debt, so now they're third in line behind it. It gets to be even more unattractive to a seller. But even this morning we negotiated a deal where we were able to not only uptick the earnout, but also get a much bigger piece if they were able to outperform. So it's there's a lot of creativity going on within the structure of the deals. Marty?
Yeah, I'd like to add a couple things to that. Absolutely right. I don't have any deals where I see seller's note right now. It's all been shifted to earnouts. I also see folks trying to find other ways to put less cash down instead of traditional indemnity escrows. I'm seeing buyers push for holdbacks, which means obviously they're not posting the cash, they're holding it back. So I'm seeing that in a couple deals, and it is sector by sector. Healthcare, I haven't seen any change in the economic terms. In fact, God bless you if you're a seller and you can get 70-30 in a healthcare deal, because those deals are closer to 80, 90, 100% cash still right now. So it depends on sector by sector, but a lot of sectors, less cash, more earnout. I haven't seen a seller's note, and ways to try and lower the cash, such as holdbacks instead of escrows. In terms of valuations, Patrick, I just want to pick up on Nick's theme. Where do you see valuations 6 months from now?
Man, that really is the question. I swear to God, it's like picking black 17, right? If there is a black 17. And it's funny because we talk about this a lot, and you guys know that I'm usually very confident in my forward-looking view of the world. And I think that's one of the reasons why even at Transact we've done pretty well, because we can, we got a pretty good grip on it. I think sector by sector, I don't think that there's going to be a complete and total fall off in 6 months. I don't. I think once we're beyond the elections, and I think we got a little bit of a view to the future, regardless of what party wins, I think that we're at least going to get some stability over the next 4 years, or at least knowing what's coming. And I think we're going to get a better view on what the cost of money is going to look like. We still have an aging population, even within the owners of these staffing companies. And as a result, we're getting people who, we were thinking about selling at 57, 58 years old. Now they're 53, 54, and they're saying, I think it's time. I've had a couple of months off. I've had all the stress and going with it. So I think that there is going to be, it's going to continue on with sellers coming into the market as a whole. I don't think that they are going to be as stringent on their demands as they're coming in as they once were. If there's one thing that staying at home for 3 or 4 months has kind of revealed to people, which is, okay, there's this quality of life that I haven't experienced in years. Maybe I want to get rid of my company now, and I want to move on and do some other things. So while I don't think that we're going to be awash in sellers, I also don't think that there's going to be a precipitous fall, and I don't necessarily seeing the M&A market within the space falling off the planet, given what Paul said, 15, 20 minutes ago about the amount of money that's on the sidelines waiting to come in. So in a really strange way, where I see it within 6 months is almost balanced from where we are right now, but certainly not a crazy uptick food frenzy.
Nick, how about, we've talked a little bit about these first-time buyers. We're still seeing traditional strategics and PEs in terms of the buyer's market. Who are the sellers today? And I'm interested from you, because I'm surprised I haven't seen many distressed sellers yet. I don't know if you're seeing anything different, but Patrick talked about the sellers a little bit. Who are you seeing as sellers? And have you seen any distressed sellers? And when do you anticipate starting to see distressed sellers?
I think the sellers right now are still high quality. As Patrick points out, I think a lot of people are starting to think about getting out, but haven't yet solidified the decision. I'm not sure it's so much age weighted. I might disagree with Patrick on that one, but folks that were perhaps scratching their head in January, February, March pre-COVID, thinking about whether or not they want to get out, are a lot more on the other side of the fence now, saying, do I really want to go through another recession and have to think about ways of bolstering up my balance sheet and my cash flow to survive the next 2 to 3 years? So I think it's those folks that are starting to enter the market, but the distressed sales are coming. I don't see any yet, but they are inevitable. They are at the onset of any recession. And I think it's a lot of those new buyers that have, $3 to $5 million in cash that are going to look to pick up 10, 12, $15 million companies that perhaps were once 20, 25, $30 million companies, and just can't figure out how to hang on any longer, or perhaps don't want to hang on any longer and would just rather take somewhat less of an exit price, notwithstanding multiples and values. If your volume has shrunk, your valuation has shrunk. And so people might just want to make a deal to just, early retire or not go through another recession. Those distressed sales are coming. They're not here yet, but they are coming.
I think in particular, I'm looking forward to or interested in seeing the hospitality sector and how that shakes out. It's such a large sector of the staffing industry. Obviously, you've got travel, but you've also got events. None of those are taking place. I know we've talked to a couple forward-thinking hospitality staffing firms, and I know they're using this time right now to kind of reinvent their business, looking at using technology, even robotics.
It's unfortunate for them in particular in many ways. One, just the sheer impact to being able to do business under COVID with mandates of shutdowns of restaurants, travel being pretty much on lockdown. There aren't that many states that are going into phase 3 or phase 4 reopenings yet. And at best, you could put, what, 10, 20, 25 tables on a sidewalk, that's, pales in comparison to what would have been, a 100-seat restaurant inside, doing 2 to 3 turns a day. So hospitality is really taking it on the chin in terms of just being able to survive. Forget about how you would even attempt to value a hospitality staffing business today, where its customers are not even at 25% capacity of where they once were 4 or 5 months ago. It's just very
we're in the
that
middle of
industry
two.
sector.
We're in the middle of 2 hospitality transactions right now, and all those observations are spot on. Which is, what is that business actually going to look like in a year? But one of the things that's inspiring coming out of that is to see the way that the hospitality guys are responding in terms of adjusting their business model and getting their cost structure down. We're seeing a lot more virtual offices. They're getting rid of a lot of real estate. We're seeing a lot of staffing companies get rid of real estate or consolidating the vetting offices that they have. So in a really strange way, I think this might actually make a lot of companies a lot more efficient, a lot more competitive. And to your point, Nick, on the distressed, I think they are coming. I think that they are out there. I think that a lot of the PPP money is kind of like when you're playing Monopoly and you're putting the jail money into free parking, and then somebody who should have probably been out of the game a little bit earlier lands on free parking and gets that money, and it gives them another life. I think that's actually happening with some of the weaker players within staffing, but eventually that money is going to run out. But to bring it back around, within hospitality staffing, there's some lessons for the rest of the staffing industry to be learned there in terms of real estate and in terms of the way that they're acquiring customers and what their business is ultimately going to look like.
And just to put a cap on that, my prediction is you're going to see in 3 to 5 years that there's going to be a couple really big winners in hospitality. And
yeah, I just want to interject one last point on hospitality before we move on. What's also unfortunate is if you were a seller of a hospitality business in 2019 and you had an earnout that went into 2020, it's unfortunate, but you're probably not going to hit that earnout target. And so even though you thought you were selling your business at a good multiple, 6, 8, 12 months ago, I don't know any hospitality staffing company that did a deal last year that's hitting their earnout target right now to get that secondary payment. So that's also a blow to that industry is prior deals done aren't meeting their earnout commitments either.
Let's talk a little bit about the curveball that the PPP loans are throwing into transactions. In almost all of the deals we're working on, the seller has obtained a PPP loan and it's creating a number of pretty complicated issues. Patrick, I don't know what you're seeing in your deals, but maybe you can talk about sellers' PPP loans and how they're complicating your deals.
Yeah, they are. It is complicated because it's these cash balances that are sitting out there and a potential liability where you've got to be able to pay it back. And you do a transaction in the middle of this, and then it does or does not get forgiven, or you have or have not been able to apply for that forgiveness. So you've got this big basket of unknown that's sitting out there. So we've seen very creative solutions from putting it into escrow. Or, for an investment bank like ours, it's always delayed closings are always terrible, but we always like to see these things go. But that's also one of those options, which is pushing it out until you actually get that notification. But the biggest thing is being able to carve off that obligation and make sure that if it is forgiven, it's obviously going to go with the seller. If it's not forgiven, then it has to be paid to the buyer because they're going to end up having to pay it back. But it is very, very sticky legally because there's also no body of law around it to be able to help people make decisions.
Well, the big problem we're seeing is that at least every one of the notes that we've seen contains some type of consent requirement for a transaction, whether it be a stock deal or an asset deal. And even just obtaining these consents has been a roller coaster. In some cases, some banks are organized enough and will give them. In many cases, the banks have no idea whether they can give them on their own, whether they need SBA blessing to give the consent. So obtaining these consents has been pretty complicated. And then how do you close? Do you close without the consent we've been dealing with? And like you said, creating some pretty complicated escrows to deal with the consents, also to deal with the fact that nobody's gotten forgiveness yet. Folks over 2 million are going to be audited. What order is that going to happen in? There's just so many complications right now. Paul, have your clients been dealing with any of these complications, and what are you seeing?
Not as of yet. They obviously are all, many of our clients have shifted to buyers. I mean, we've talked about the additional liquidity that PPP has brought to the sector. So plenty are buyers. They are pursuing and looking at opportunities, but most of our clients have not reached the point where they're executing on transactions. We have to address the consent issue and escrows and so forth. But those are discussions that are in place, and we're seeing the same exact things that you guys are seeing. But the PPP and the liquidity, going back to earlier, that's likely to really drive this market more than anything.
Nick, one thing that and maybe you're working with buyers, one thing that we've been really working on is very specific reps and warranties around a seller's PPP loans. What type of protections have you been working with buyers in terms of buying sellers who have PPP loans?
It's an interesting dichotomy because, as Patrick and Paul point out, you've got anticipation of forgiveness, which isn't there yet. And in a traditional M&A deal where the seller gets to keep the cash, but also has to keep the debt, they have the cash from the PPP loan, but they're hoping they don't have the debt. But since it's not forgiven yet, what tends to happen is you take that amount of cash that's equal to the debt and you put it into an escrow account. And you wait for not just the forgiveness process, but I happen to believe the audit process needs to come first. The audit process is going to be most likely two major phases. One is first going through all the attestations and affirmations that the staffing company borrower made on the front end. Did you really need the money? Did you have access to other sources of liquidity? How was your business impacted? That's going to be part of the audit. The economic part of the audit, what you spent it on, payroll, rent, utilities, is the easier piece of the equation because that's more factual and a lot less subjective than the needs attestation. But I think that audit process, my opinion is that's going to be pushed down to the banks, not the SBA. Depending upon the bank is going to help us understand whether or not the bank even has the right personnel or manpower to conduct such an audit. So the fact that people now might not opt into the 24-week spend period, but stay with the original 8 weeks spend period, can't even apply for forgiveness yet because the rules haven't even been worked out. So layer all that on top of a deal, and what you get to is a big fat escrow account saying, put all your PPP money here, seller. You can't have that cash yet because your debt's not forgiven yet. And if you have to pay it back, the funds are escrowed to do so. And what's really important about that escrow account is that escrow agreement needs to be written in such a fashion that it doesn't create cancellation of indebtedness income for the seller, because if that cash is deemed to be buyer's cash and that debt is deemed to be buyer's debt, the seller just got an artificial increase in purchase price by cancellation of indebtedness and now has higher taxable income without the cash to pay the tax. So those escrow agreements need to be worded very, very carefully that this is seller's money and this is seller's debt and seller's responsibility. And the escrow is used to alleviate that debt and only that debt.
You're 100%.
That's why we like you as an attorney, Marty.
He's 100% correct. But also the other issue besides the tax implications are when do you release the money? Everybody talks about forgiveness, right? We don't know what order things are going to proceed in. We think we know, but we don't know. And it's really the discharge of the loan obligation. It's not the forgiveness, right? The note is going to be discharged in some way. So structuring when that money comes out of escrow is very important and very complicated as well.
Yes, it is. I agree with that.
Well, as well as what the IRS final rulings are going to be on the allowable expenses and whether or not they're deductible or not, because we all have speculation on how the IRS is going to conclude on that, but I don't believe there's been 100% guidance on it, unless Nick, you know otherwise.
No, I don't, but I have a very good feeling that Treasury Secretary Mnuchin is going to step in and make the final call on that. It's inconceivable that the government put this PPP loan process out there in the beginning with an eye towards if it's forgiven, it's not taxable. And then somehow the IRS comes in with some regs that were in the closet and backdoors you that, well, the income might be non-taxable, but what you spent the money on is now going to be non-deductible. Just seems to be an inconsistent position that borrowers were under the interpretation of on the front of taking the money. So I think Mnuchin's going to have to square that away and make it a truly forgivable loan, especially to these small businesses.
And that would have to happen before the election, right, Nick? I mean, that would have to happen before an election because otherwise, if you have a change, you've got the IRS. Yeah.
It'll be a morass. Yeah.
Go ahead,
I agree with you. I would just say that could be another delay until that final ruling comes into play.
Yeah. I don't know of a bank yet, by the way, that has started the audit or forgiveness process, and that's because the interim guidance on forgiveness is still being looked at and is destined to be modified yet again, and those modifications aren't out yet. So everybody's in a as a borrower, forget M&A, but as a borrower of PPP funds, you're in a very frustrating wait and hold position. You can't do anything about processing a forgiveness application because the SBA is not accepting it yet. So the banks aren't conducting forgiveness audits and forgiveness diligence yet. And so everybody's just in a big wait and hold, let's see what happens with these rules pattern.
We got a couple questions. Most of them evolve around economic terms and the impact on economic terms. We talked a little bit about that, Patrick, but folks are asking if there's been changes in the formula for calculating earnouts and what we're seeing in terms of formulas that are being selected. Do you want to talk about, Patrick, what you're seeing in terms of the actual formula for calculating earnouts?
It's a great question because, a lot of times we're trying to negotiate it on gross margin, right? Because at least that's something you can kind of control. You're controlling the revenues, you're controlling that cost of goods sold. And as soon as you start getting down to actual EBITDAs and things like that, it gets very dirty, it gets very noisy within the numbers itself. But what we're starting to actually see is earnouts based on, we've had buyers ask for earnouts based on customer retention, percentage of customers retained, percentage of dollars per customers retained, and doing it averages over that because they're really afraid that the customer base is going to evaporate. When Nick's talking about distressed companies coming down the road, it's not just about the staffing companies, it's about the staffing companies' customers that will ultimately be in distress. And as those start to go away, the buyers are at risk. So in terms of that, we are seeing a lot of different ideas in terms of how those earnouts are going to be structured and going to be based. Some of them are trying to put those earnouts a little bit further down the road too, right? And try to push it out there. But obviously that puts sellers a little bit on edge because, you never can really let go until that's over and done with. And also when you start to see the shorter ones, that means that the recovery has got to be, pretty strong, pretty fast in order to hit those earnouts. So there's no real clear pointing. I think everybody is figuring out where that risk is going to lie, but at least they're trying to push a lot of different buttons to figure out for the individual buyers what that earnout should be tied to.
Nick, what are you recommending buyers for your buyers in terms of how to create the formula for earnouts?
Yeah, as we said earlier, this is all about risk shifting at this point. And buyers are, again, looking to shift the risk back to the seller, whether they're basing earnouts traditionally on gross profit or whether they're basing it on a percentage of customer retained. If you're a typical $25, $30 million mid-sized staffing company, more likely than not, 8 to 12 of your top clients represent 50% or more of your revenue. So losing one customer changes your needle by 10 to 12%. And is that significant enough to be a spoiler for the entire earnout? This is what's at risk today. And so how does a seller guarantee to the buyer that they're going to deliver what the buyer is willing to pay for? That's somewhat of a rhetorical question, but that's currently the types of discussions that are on the table today. And the new mousetrap is how best to capture those economics in legalese so that sellers are comfortable that they're going to get some type of a shot at making that earnout, and buyers are comfortable that they're going to actually get what they're willing to pay for.
Yeah, we've seen a combination of things in that regard. We've seen a lot of folks asking for MAC clauses. We've seen a lot of folks really working hard to describe kind of these new formulas, because what we saw, I'd say, and I know, Patrick, if you agree or not agree, what we saw in the first quarter and in 2019, I saw most of the earnouts, if there were earnouts, structured on EBITDA. I mean, that was, to me, the biggest earnout formula used. I don't have a single deal where an earnout is structured on EBITDA right now. So, it's made it a little bit more complicated, and working out exactly what you're trying to accomplish and how you define it is difficult. I think this segues into, really, Paul, an area where you have a lot of expertise, because your underwriting isn't that much different than financial diligence in M&A. Talk about recommendations for financial diligence today.
Yeah, no, it's we've touched on things throughout, but historically, people relied on QOVs, your TTM, to look at, what I said earlier, predictability of revenue and EBITDA, with definitely a fair amount of forecasting. The forecasting today is like, we've never seen before, and trying to be forward-looking to figure out how certain companies, sectors, regions come out of this thing, is challenging. Now, we know that certain sectors, healthcare, IT, have fared better than like hospitality. But then you have to go to, as Patrick mentioned earlier, you got to get to the customer side. And we're doing more diligence on our clients' customers than we ever did. What sectors are they in? Have they been impacted? What potentially, how they could be impacted down the road? What budget constraints could they have that may impact their spend and reduce their purchasing power with our clients? So there's a lot of different variables that are going into the the underwriting component, and financing is not going to bear as much risk as we had historically. And you're going to see, as what Nick and Patrick had mentioned, we're seeing a lot of the rebalancing of risk to be borne by buyer and seller, and clearly the sellers bearing more risk than they have in the past. But we're seeing more dry powder in transactions as well.
On that due diligence front, I know Nick's going to have an opinion on this one, but the deeper dives into due diligence. A lot of times there's things that when a buyer goes into the data room, it's kind of a check the box. Do you have that? Do you have that? Do you have it? We're actually seeing, this is a really bizarre measurement. But when you actually see the amount of time that buyers are now spending in various folders in the data room itself, and the amount of time that they're looking at the data, it goes up. This is like one of those Moneyball metrics that nobody knows that they're, that they didn't know that it was an important metric. But when we're starting to see a lot more requests on revenue bridges, and people going in and saying, okay, how's this going to waterfall out? What are the real contributors to profitability? Where are we in terms of total amount of hours to be able to get something done? We're going through a pretty massive tech staffing deal right now that we're going to be closing in a couple of weeks, and the due diligence has really been amped up, and we're seeing that across all sectors. But especially in some of the more risky ones, that people are trying to get that clarity going forward. So due diligence has become much more intense.
As a comparison to the prior recession, people will generally look at contingent staffing as a leading economic indicator, and it is. But we're not seeing people just rely on that globally anymore. You really got to break it down by sector and go even further into the clients' customer concentrations more than before.
Can I jump on that too? Because we had two staffing companies of equal size, probably about 10 miles from each other in various markets, or in the market. Okay, so they're almost identical. One saw a 30% drop off in its business during COVID, and the other one saw a 10% uptick. And these companies ostensibly are identical. They're identical in sales, they're identical in revenues, they're identical in EBITDA. But you see one just had a stronger and better customer base to it, and they thrived through COVID, and they're going to continue to. And the other one saw its valuation just get eroded pretty dramatically, and now every supposition that they have going forward into 21 is in question because they have to go line by line on those customers. So it is a real thing.
Where the rubber kind of hits the road here on financial due diligence, though, is taking what Paul said about the look through to the ultimate customer and taking what Patrick said on the look through to cash flow and sustainability impact. This all drives financial due diligence and, more importantly, a working capital target. I don't know of too many staffing companies that have a better DSO AR turnover today than they did pre-COVID. Healthcare and tech, perhaps leave out of the equation because depending upon how strong their customers are, typically dealing with large networks and Fortune 1000. The typical accounting and finance, the typical light industrial staffing company is going to have working capital issues as their customers are also impacted by COVID. So a higher working capital target means more deliverables by the seller, means more cash not in their pocket, means that working capital probably has higher debt behind it from it being financed either through an ABL or a PPP loan. But nonetheless, there's more debt on that balance sheet as well if your DSO is up. And the focus on the financial due diligence is going to be exactly there. Are these customers going to pay? Are they just going to pay slow and therefore we need that working capital? Or is there really a greater risk of bad debt and of shrinkage, and you're continuing to make bad business decisions as a seller, continuing to sell into a customer that's ultimately going to hurt you at the end of the day? So sellers and staffing company operators today need to take a real strong look at their current client composition and how willing they are to continue to extend credit terms beyond the normal 40, 42, 45 DSO equation that was pre-COVID. You're really not going to do yourself a good service, or in fact a disservice, by ignoring that. That's not going to help you if you want to become a seller.
Patrick, let's kind of like take this back to the beginning. We started off with valuations, right? Well, you got to get to a valuation, right? And EBITDA is typically the standard for valuation. How are you determining EBITDA given the second quarter going into the third quarter? Are you including that when you determine a company's EBITDA? Are you carving that out? What are we seeing in terms of EBITDA used for valuation purposes?
Yeah, this is the $64,000 question now, isn't it? Because you've got people who want to argue about surgically removing that quarter. Right? Or don't look at it. Don't count. And that's not even remotely realistic, right? It's not. As a matter of fact, ironically, we're getting buyers who are asking us to go back and look at 2008, 2009 and say, how did this company do in the last recession over there? And how quickly did they bounce back? And we're like, well, data's 11 years old, 12 years old. Who cares? But what we are seeing is in terms of the pop back up and looking at those trailing 12 months, I'm actually seeing within buyers a little bit more understanding, especially when they're strategic buyers. When we have strategic buyers, they get the dip that they saw during COVID, and they're actually willing to forgive it and kind of flatten that out a little bit in terms of their projections. It's not just a pure valuation based on what it should have been or what it actually was. In terms of being able to calculate out what that EBITDA is going along with, there's been a whole host of different ways that people have looked at it, but for the most part, you can't ignore the drop. You just can't, and that goes back to that shifting of the risk going forward to say, fine, if you bounce back and things look the same, we'll give you that earnout going forward. And I think that's where that measurement is being impacted in terms of valuations, Marty.
That is exactly why the weighting of cash to earnout is changing to that 60-40 or some lower mix. That is exactly the reason. And so as a seller, you might scratch your head and think a little bit contrarian, saying maybe I should take an 18 to 24 month earnout instead of a 12-month earnout, give myself a longer runway to recovery and a better shot at gaining that earnout versus the next 12 months, which are, to me, the most cloudy inside anybody's crystal ball. Is when you're going to come out of this, how quickly you're going to come out of this, and when you're going to get back to more sustained and more predictable numbers. I think the longer you take an earnout out down the road into the future, the better you're going to be in terms of being able to hit that trajectory. The shorter earnout period is where I think the most volatility is right now for a seller.
In terms of calculating EBITDA, Nick, what are you seeing buyers do and using that in valuations? Are they carving out? Are they using something similar to what Patrick said? What are you seeing on that?
Yeah, I would mirror what Patrick's saying. I think EBITDA is what it is. I think buyers might be more willing to bend a little bit more on the adjustments to EBITDA to help a seller get a somewhat more reasonable purchase price, because let's face it, if that expectation gap of seller's value and buyer's value is too large to bridge, there's just not going to be a deal. So the importance of a quality of earnings report today is all the more paramount than it was pre-COVID. But I think given a proper QOE report, buyers are still willing to bend even those numbers a little bit to help bridge that valuation gap between what's in a seller's mind and what's in a buyer's mind. And I think those discussions are unique to the facts and circumstances of a particular target and buyer. And I think certainly one of those caveats is less cash up front, more earnout. I'm happy to pay you more, Mr. Seller, but I'll give you a longer runway on the back end to prove it and to earn it back. And earnouts in my book always have a collar. So if you exceed the target, your purchase price actually gets increased. An interesting mechanism that we used in the last recession that I think will get pulled out of the bag of tricks this time around too is an earnings collar and a look back adjustment, so that if you didn't hit your target in Q1, Q2, or year one, that on a cumulative basis, if you really pick up in that V-shaped recovery in Q5 or Q6, and on a cumulative basis hit your target, you get the entire earnout. You don't lose those first quarters. So clawback mechanisms, I think, are going to help balance that risk that is starting to get pushed back onto a seller.
Nick, we're already starting to see the collars. We're already starting to see, hey, if you miss the next couple of quarters, we'll push it out. We'll look at it in the first quarter of 21. You can have a chance to make it up. We're seeing substitutability of contracts. So if you lose this major contract over here from this big client, but you are able to replace it over here, we're going to continue it. We're going to count it as basically being the same. As a matter of fact, we just negotiated a deal on that, right before this call. That was one of the issues. So there are some very interesting ways to be able to do that, as you pointed out.
Yeah.
Especially
Unless a buyer wants to get into a specific client or clients that's in your portfolio, is where
exactly.
Transferability of client really comes into play. But if I'm a buyer and you're a seller and you're a prime vendor at Wells Fargo, and I want Wells Fargo in my portfolio, and the only way to get it is to acquire your preferred vendor status, and then we both lose Wells Fargo, that's not what buyers are looking for in terms of replacement of customers. But more generically, yes, I can see how that works.
Yeah, but what's interesting about what you just said, though, is that this makes it a very interesting turn for strategics versus financial buyers, though, because now, especially with the virtualization of some of these offices, where they can actually see clarity on how they're going to be able to save costs on the long term of bringing in another customer or bring another company, but they also get access to that customer base that it's a lot easier to buy at this juncture. So it'll be interesting to see what happens over the next 6 months in terms of strategic versus PE shift, because we've seen an awful lot of PE money come into this industry in the last 4 or 5 years. And now that they actually have platforms and positions there, and all those little tuck-ins are coming in, it'll be interesting to see. I don't think that there's going to be a tremendous amount of PE entering the industry, but I think the ones that are here and already have strategic positions are going to be acquisitive.
Yeah, I don't disagree with that at all, Patrick.
All right, gentlemen. We're going to have maybe one more round of questions. Audience members, this will be your last chance to submit questions. So if you have any questions, please submit them now. Let's go around the horn one time. Paul, maybe sum up what you think is maybe the most important point on financial diligence that the audience members can take away from here.
Yeah, just really forward looking. The best you can do to sensitize whatever forecast and whatever the seller that you're looking to buy has performed historically. Obviously, carving out, as we said, recent COVID impact. But if they've been impacted by COVID, when is that going to come back? If they haven't, what's the long-term economic risk that sector or the seller's customers might have? So I really feel that it comes down to the forecasting and the forward-thinking forecast with regard to structuring your purchase price.
Thanks, Paul. Patrick, a little bit different question. Valuations a year from now, how do they look compared to today?
I think it's going to be dependent on sector. I really do. I think predominantly in the more traditional type staffing models, I think they're going to be flat to a little bit down. I think within the tech models and the medical, I think they're going to continue to climb and escalate. I really think within tech, especially we're starting to see it in any tech staffing firms that are doing cybersecurity or anything along those edges. I think sellers have to make a decision at this point whether or not they're going to put up their sail through this storm, or whether or not they're going to try to move it on right now. And I think that's going to be the real determinant in terms of supply and demand of what's going to be out there to buy that's going to impact it. Overall, though, I don't see us returning to the multiples that we saw over the last 4 or 5 years for a bit. I just don't. Except within those two particular sectors. And even then, I think they're going to be a little bit, they're not going to get as heady as they did in the other ones. But I think that we'll probably see a softening of those multiples. I do.
Nick, one last question for you. Do you foresee a big distressed market? And is it a market that buyers are going to be able to pick up, to cherry pick good assets out of?
The latter part of that question is easier to answer than the first part, so I'll answer backwards. Yes, it'll be easy to pick them up. I'm not expecting there to be a lot, but there should be a good amount of distressed sellers out there. One of the things we touched on but didn't really get deep into is if you were a traditional staffing company that also had a perm placement book of business, you might have had an 80-20 mix of contingent staffing to perm placement, or even an 85-15 mix. The perm business has been very, very hard hit. And an old 80-20 mix is now probably 95-9 or even 98-2 right now. The perm business has been really, really hit hard. I wouldn't say it's zero, but it's less than 10% of volume of what it used to be. And so the distress part of that equation is going to be impacted more so if you had a heavy perm revenue business production. Those are going to be the companies that need to think twice and long and hard about internal staff layoffs, rejiggering their relationships with their customers, refocusing less on perm, more on contingent staffing. And if they can't do that, and if they can't change gears like that, they might become those distressed sellers.
We got a question
Yeah,
from
I
the
want to. Do you mind, Marty? Because I want to. A good operator is always going to be valuable. A good operator will always, if you could focus in on one thing, it's the good operators sell well.
Got a question from the audience in terms of multiples and what we see today versus looking forward in what I'll call professional staffing, legal, and accounting. What are we seeing in multiples today, and what are we looking at multiples in those two areas 6 months or a year from now?
From our perspective within legal and accounting, the accounting, the deals that I'm working on within the accounting space have gotten beaten up a little bit, more than the actual legal ones. The legal ones have actually remained flat, not an uptick. They've remained flat, but I've seen the accounting ones fall off slightly. Nick, it'd be interesting to hear what he had to say, obviously, because that's
as a former accountant and senior partner in a big accounting firm, they're struggling right now. There's a fair amount of layoffs in large CPA firms. Nobody's really hiring perm A&F right now. My crystal ball says A&F multiples certainly tick down, maybe between 50 and 100 basis points on the multiple going forward. So if you were at a 5 multiple, you might very well be at a 4 multiple at the end of 2020.
Yeah, and Marty, you seem to be insulated on legal, so.
Look, I think you could say legal should expect the same thing that Nick said about accounting. It's a struggle right now, and it's going to continue to be a struggle for a while. Next question that we got in: are we seeing any geographic specific impact on M&A in terms of volume, in terms of valuations, anything geographically specific?
Yeah, I'll answer that because these are the calls that I get in from the hunters, from the people that are looking for things. Texas continues to be just blistering. It is. Everybody in the world wants Texas. California continues to be the laggard, and honestly, if you turn on the news, they're not doing themselves any good over there. I mean, they're just not. So I keep getting the comment of anything except for California. But it continues to be predominantly down through the south. We're still seeing some pretty good demand, even up into Wisconsin, that area up there. But within the Northeast, it's fairly quiet. That's what we're seeing in terms of demand.
Anybody seeing anything different?
No, I think the Northeast is holding its own. I can't attest for most of the other parts of the country, but deal activity in the Northeast has been put on pause, but it's ready to come back online, and I think it's going to come back online strong. perhaps with different multiples, perhaps with different economic caveats, but it's going to come back online, and it'll come back online quickly. There's a lot of money on the sidelines waiting to get back into play.
Okay, we've got a few questions. I'm going to take one more question and then we'll call it an afternoon. There's another multiple question, which isn't surprising. Traditional commercial staffing, we've already talked about that. That's taken a little bit of a downtick in valuations. The question is, where do you see that in 6 months or a year from now?
Yeah, that one, depending on the region and depending on the customer base, I do see that one continuing to fall off. We had deals that were starting off at 5s, then they're down to 4.75. I can actually hear some of the buyers starting to try to get it down to 4.5. I think it's going to start settling down, and it's probably going to end up somewhere down between the 4.25, 4.5, right around there over the shorter term. And that's for a really well-run company. That's for a company that's got some degree of stability.
I think commercial staffing is going to be more dependent on who the customers are than ever before. It's going to come back to credit risk. And if you're working through a big MSP and that ultimate customer is slow paying, your MSP is paying you even slower than that customer. And so credit risk and customer concentration are going to be the levers of what drive those multiple impacts that Patrick was just talking about. That's the source of it in my mind.
Well, gentlemen, thank you. Appreciate your time today. Everyone, as I indicated at the beginning, this was recorded. We will be sending it out to everyone. And I wish everyone a good rest of their day. Take care.
Thanks for being.
Thanks, everybody.